everyone. Thanks for joining us again. A great new website. Please check it out. I really love it. It's different than our last one, and there's always tons of materials there. I point that out to people, lots of resources. It's been a while since we've done this, as David pointed out, and some of you know, many of you may not know, but today, October 14th, is my 2-month anniversary of my new aorta. I have a sample of it here. I had open heart surgery. They found, and it's genetic, an aneurysm. So I went under the knife exactly 2 months ago, August 14th, and they cut me from here to here and completely replaced my aorta. So I have a prosthesis, a brand new aorta. So the team did a great job of keeping things going. And while I was in the hospital for a while, I was intensive care in the hospital and then recovering. But here I am back, like nothing happened. So that's just to share on a personal note. But we have such a great team, and I'm so proud of everyone. And I've gotten nothing but positive feedback from people who have been working with us while I was unavailable. So that on a personal note, just to go through a few quick things. If you do have a question or a comment or something, feel free to participate. You can put something in the Q&A or the chat feature, and we'll get to that at the end. A few quick economic and finance points. There's a lot going on, of course. The Social Security cost of living adjustment, which was supposed to be announced earlier, is now going to be announced October 24th. This is because of the government shutdown and going on 2 weeks. And the expected cost of living adjustment for people who are getting Social Security is 2.8%. We'll know that officially October 24th. Also, we have 2 more Fed meetings. These are 2-day meetings coming up this year. The second day is when they announce changes in interest rates, if any. And so that's October 29th and December 10th. The markets are pricing in a 1/4 point cut both of those days. And I tend to agree with that. A lot of it is data dependent, and our data is now not the same as it was because of the government shutdown. And inflation is still much higher than the Fed wants, and it is possible that the inflation will continue to go up a little bit more. So cutting rates goes against. I didn't turn my phone off. Cutting rates goes against the goal of controlling inflation. So excuse me here, make sure that doesn't happen again. But we're going to, that will stimulate the stock market likely. So that's where people have optimism about growth in the stock market. One thing that came across my desk, David Trotman talked about, wealth and well-being. And we always try to do whatever we can to help people, financially. And one of the things is to be aware of scams. And this is a scam that's going on in South Florida. So I'm just going to pass this along because the scammers get more creative. And there's a couple going on with jury duty and also with traffic tickets. And what the scammers do is they do a simple search with common last names, cross-reference date of birth, and then they pull like a traffic ticket, the original ticket. So they're master manipulators. They make it sound official. They have so much information, and then they ask, to be paid, or you're gonna get into trouble. And this is all fake. So if you get something like this, most people would question it or have a concern. But it's a scam. Just to confirm it, it's a scam. The authorities never reach out to you this way. So that's going on. Unfortunately, there's always something new. Then also, I want to mention we do have a new service called wealth.com. It does have a separate charge, but this is where it's approved by our broker dealer, Cetera Advisors, where people can get legal documents done. So it's part of a financial planning package through Cetera. We send you like the documents to sign up for it. It's $1,000 to be able to do a full set of legal documents, and you go through a Q&A. And they are legal documents. So you can do a will, power of attorney, advanced healthcare directives, a living will, a trust. And so it guides you through it. You answer various questions. Then it will tell you how to execute the documents. Here in Florida, it's with 2 witnesses and a notary. but it's for all 50 states. And then once you have it, you basically are set. You don't have to worry about going to an attorney to update your documents. We should be able to use the same system to do that in the future. So if you have your documents done, you're set. If you don't have the documents done or they're old and need to be updated, we have a way to do it. We still always say don't hesitate to go to an attorney, an estate planning attorney. But if that's an obstacle, it's too expensive, they're too hard to find, then it's this is a great alternative. And the reason we have this alternative is all of those problems that people are just delaying and getting documents done. They don't know where to go, too expensive. And it's like someone said, I get ghosted, I get started, and then there's a series of meetings and follow up, and it just falls through the cracks. So we have a program there for that. So don't hesitate to reach out to us and ask, and we can send you information on that. We have a tutorial even. Now, let's talk about what's going on in the markets and the economy. Of course, we have the government shutdown. One of the things that's interesting is you have the index of consumer sentiment that has come out. That's the University of Michigan one you hear that comes out. It's on Fridays. It's like twice a month. There's a preliminary and then a final, and that shows that the public is not concerned yet about the shutdown. It's just not affecting most people individually. Now, the longer this goes on, the more that can change. It's probably going to affect the Washington, D.C. area because of all of the federal employees. But that's just an interesting thing to note. What people are concerned about right now is a concern in the stock market, and talking about the stock market, is a bubble. And you may have all of a sudden the market has gone up so far, so fast from the after April, the Trump tariff tantrum, as we called it, when the market tanked, that people have been concerned about, is there going to be a correction? The one thing I want to say is when we say correction, we're talking about a 10% drop in the stock market. That's normal. That happens once a year typically. And then the market, it's often healthy. The market corrects. We call it a correct. And then it starts its march up. And so that's not so much of an issue. Even bear markets, where it's a 20% fall, are normal. Of course, that's not fun. We want to try to avoid deep drawdowns that will last for a sustained period of time. What some people are concerned about is more than those things. They are concerned about the tech bubble of 2000, 2001, 2002. They're concerned about the housing crisis, the everything crisis of 2007, 2008. I'm going to say nobody knows. Nobody knows what the future holds. And I'm going to share all sorts of commentary right now. And it goes both ways, where people are saying there are all these warning signs and be careful. And others are saying, no, this is different than what the tech bubble for specific reasons, which are true in terms of those reasons. And so it's hard to know. I am not as worried in the immediate term because I do think those interest cuts and plus the interest rate cuts plus the corporate earnings are relatively positive and the forecasts are positive. That is at least over the next half a year. I'm going to share something with you, though, about this kind of funny. This is from marketwatch.com, and it tells you how crazy the times are. On Friday, we had a market meltdown, and this happened because of one thing, Trump's comments about China and 100% tariffs, which we went through before, back in April. And so the market melts down. So this is from MarketWatch. Futures early on Monday, yesterday, show stocks striving to recover a fair chunk of Friday's slide, which came after President Trump reignited trade angst. A new social media post from Trump saying that the dispute with China will be all fine helped trigger traders buy the dip muscle memory. And the point is that the market was sunk and came back. And so here he says about the market coming back so fast, the attempt to ameliorate market tension came quick. But then taco is a fast food. Taco referring to Trump always chickens out. Taco is a fast food. It's like, okay, fast. The market recovered fast. This is in this article at the beginning of the article from marketwatch.com. And so I just wanted to share that. What he said is to correct what he started with this free fall on Friday is this was the post on social media, his Truth Social. Don't worry about China. It will all be fine! Exclamation point. Highly respected President Xi just had a bad moment. It's Xi who had a bad moment, not Trump. He doesn't want depression for his country, and neither do I. The USA wants to help China, not hurt it. Exclamation point, exclamation point, exclamation point. President DJT. That was the post. This was not a Saturday Night Live. This is the actual post. So there's some concerns there. Um, Here, this is Julian Emanuel, Chief Equity and Quantitative Strategist at Evercore. He thinks that, like the start of the two previous earnings seasons, the market is entering this one with significantly improved sentiment. We're talking about this new quarter. In contrast to the first half of the year, S&P earnings per share estimates have been revised materially higher. So, this is true. There's a more optimistic tone, and it's been underpinned by a stable economy. The Fed's starting to cut interest rates again because it can. Revived capital markets, and all of the AI themes here. So, of course, the S&P is trading a bit high, so there's the price to earnings ratio. So there's some concern there. But there's a lot to be positive about. And here, this is a strategist, Michael Wilson of Morgan Stanley. He talks about this little mini bear market for one day. He said the stock market was set up for a correction. This was not a correction. So this is where I call out comments like this. This was all political commentary. It has nothing to do with being a correction. This is some positive feedback, and I want to share this. So he's seeing, this is Morgan Stanley, the S&P 500 resuming its climb, arguing that the broader cycle still looks early stage, that we are still at the beginning of a long-term bull market, despite rising volatility and stretched valuations. Not only that, he says, but the recession risks are behind us. And I think that's true. Nobody is predicting a recession, 2 consecutive quarters of negative economic growth. In fact, the GDP numbers are going to be largely very positive. He said he maintains that a second larger sell-off is only likely if there's political issues. So that's like between China and the United States. So to be clear, if we shelve the geopolitics, the optimistic case for stocks becomes hard to refute. So here he says, the bull market just reached its third anniversary. History suggests there's plenty of upside. The Fed rate cuts are expected, multiple rate cuts. The AI, artificial intelligence momentum is not only strong, but accelerating. Only one bull run since World War II hit 3 years without hitting a fourth. So the forecasts, there's optimism for next year. As we get towards the end of the year, a lot of investment managers and economists do their predictions for the following year, for 2026. I keep track of those, and I'll do another Treece Talk on what those predictions are. And there's some that are much more negative, some that are more positive. They tend to go to a middle. But just to share that there's a lot of optimism here that, given fundamentals, unless you have geopolitical problems, that the markets will do well. Now, where are the risks? This is the other side of the coin. And here we've seen gold go through the roof, cryptocurrency. All of these things, these two things are soaring while the stock market has gone up. This is not typical with gold in particular. Normally, there's negative correlation that people are investing in the stock market and then gold goes down. Or if there are problems in the stock market, political problems, concerns, then they go to gold. And that's clearly happening, that their gold is reaching record highs and incredible growth, outpacing even the stock market. That's a warning sign that people do not trust where we are right now. They're looking for safe havens. Some people consider cryptocurrency a safer haven simply because it's not tied to the dollar, what they call a fiat currency. And I'm going to share some comments about that here. This is from Citadel, Ken Griffin, who moved his company here to Miami, actually, a billionaire. This was from Bloomberg. We're seeing substantial asset inflation away from the dollar as people are looking for ways to effectively de-dollarize or de-risk their portfolios vis-a-vis US sovereign risk. That's a big deal. The value of the dollar has been tanking. In fact, it's the lowest, I believe, since 1973. So that's, in fact, there's this whole talk of a debasement. That is great for U.S. exports. If we're trying to produce things here and export them, a lower dollar is better. It's bad if you're traveling abroad or living abroad and you're getting paid in dollars. So, here, this is from Anthony Pompliano, who's a big fan of cryptocurrency. You always have to take these with not a grain of salt, but consider the source, so to speak. What biases may be there. And he said, it's not every day, referring to Ken Griffin's comment, that you see one of the world's best investors say people are de-dollarizing their portfolio. Why would they want to de-dollarize? Goldman Sachs says the story is simple. Trump said America can grow its way out of debt. What it really means is debasement. Shutdowns highlight the erosion of trust in U.S. institutions. Bitcoin is the pressure valve. That's not bearish the S&P 500. It's bearish the dollar. So just to point out, something else is going here. There is erosion of trust in U.S. institutions. This is absolutely true internationally. The president of Finland at the United Nations General Assembly, in a short speech that went viral, said, we are entering into a new world order. And he said, we don't know what it's going to look like. We probably won't know for a few years. And I think this is true. The United States position in the world has absolutely changed. We are not the same country internationally that we were before. And that is in terms of our allies, in terms of the dollar, in terms of trade imbalances. It's a whole new world. So there's a lot of concern there. One of the things there are all these examples. One that's personal to me is Argentina, and this bailout of Argentina. And for those who don't know, my husband is from Argentina. We've been together. In fact, this month, October 26th, is our 40th anniversary. And we were there. We have a farm in Argentina. Half our family's there. And we were there in December of 2001, so a long time ago, the banks closed. It was like the Great Depression in the United States in 1929, and you had 5 presidents over the course of like 2 weeks. People coming in and then resigning, and a total crisis. So, and the Argentine peso 1 to 1, and then it became worth like pennies on the dollar. So you had massive poverty. People adjusted, but it was such a huge crisis. So there's been a history of mismanagement there, overspending, too many people on the public payroll, too much debt. Sound familiar? The United States. I make some comparisons with Argentina. But the point that I'm getting is that this is almost unprecedented, this intervention in another country's economy to this extent, an economy that is not critical to the United States, despite Scott Bessent saying it is. The Trump administration has argued that Argentina's financial strife could spill over into other economies if it isn't contained swiftly. This is completely false. Argentina has collapsed and defaulted on debt several times before. There's no contagion. In fact, one of the frustrating things for me is you go to Uruguay or to Chile, they don't have the same problems. They have not had hyperinflation. They have been more stable. And so this idea of contagion it's absolutely true in other situations, but it's not true here. Administration officials say they also see a risk of Argentina, a major economy in South America, which is true, strengthening its ties with China. This is completely true. It's already happened. And the issue here where farmers are furious is soybeans. I follow the Argentine news, and it's just stunning where Argentina is running out of dollars. And so they have something called retentions. This is the taxes that they pay, that the farmers pay to the government. They canceled all of the taxes for brief. It's like a tax holiday. And the idea is sell the soybeans to China. And China stepped in and bought like crazy. And so the reason for doing that is they get paid in dollars. So this was a way for the Argentine government to get this a furious influx of dollars to avert a crisis. All of this has to do with just one thing. There are elections coming up in Argentina on October 26th. The previous elections, the President Milei, his side lost unexpectedly and severely. And he himself is not up for re-election right now, but it is largely expected that this will continue, that his side will lose badly coming up at the end of the month. So this was an attempt to interfere in another country's elections and to try to buy the election and keep them going. And the only reason is that Milei is this outspoken mini Trump, and that some of what he's done has been copied. Like he had, the chainsaw. So it's completely political, and it is bad money management. And it seems very likely to me that the United States will come up on the short end of the stick. And certainly American farmers have come up on the short end of the stick. Where we are, our farm, all around it is soybeans. And it all goes to China. And it's been that way for a long time. So just to point out that the way this was done, the United States directly purchased an undisclosed amount of Argentine pesos. It's only the fourth time since 1996 the United States has bought another country's currency, according to the Federal Reserve Bank of New York. The other times it was like Mexico, backing up Mexico. So there's usually a crisis that does affect global instability or directly the United States. So this bailout isn't urgent. It's happening at an awkward time, and critics are accusing Trump of using billions of American dollars just to prop up one of his own personal allies. This is absolutely the case, and it is the only reason, and it's irresponsible. So did I tell you I have opinions? So these are the kinds of things that are happening where there is concern about the United States, the norms, where this is different, the changing world order. So it's not just about the economy here in terms of the corporate earnings and inflation, unemployment. There are just a lot of signs. This is from Andrew Ross Sorkin, who is a writer and journalist, and he's got a book coming out on the 1929 Great Depression. So, just to point that out, he's predicting that there will be a crash, but of course nobody knows when, and he's saying that here. But it's some of the things here that are probably true. That right now there's this investment in artificial intelligence, and not all of it is going to be profitable. That's normal. You have winners and losers. Here he's quoting, here's from JP Morgan Chase chief, Jamie Dimon. He's far more worried than others about a looming correction in US stocks, meaning a drop of 10%, but not more than 20%. And he said that likelihood of that's about 30%. Others are more negative, that we could have more of a serious market crash. To go back in just to talk about that, 2000, 2001, 2002, we had 3 years of double-digit losses in the market. So that had not happened since 1939, 40, and 41. And so here, after all of this tech enthusiasm, a lot of it, though, was smoke and mirrors. You just put a .com after something and people were investing in it. So, and it took years for the NASDAQ to recover. So, three losing years in a row, double-digit losses. That's something to pay attention to. Then 2008, the market, the S&P 500 was down over 50% at one point. It finished down about 38%. So, of course, it comes roaring back. Even 2022, the NASDAQ was down over 30%. So it's you want to keep perspective that if you're longer term, the markets have historically come back. Um, Here's another concern I want to say is that we're starting to see failures. One of them that's been in the news, a company you've probably never heard of, First Brands. It's an auto parts supplier, sells things like oil filters to customers like Walmart and AutoZone. They went bankrupt last month and they filed for Chapter 11 with an eye-popping $10 billion in liabilities. And it's under investigation now. First Brands relied on obscure financing practices from private lenders to keep itself afloat, and its collapse has exposed private credit. And I think there are risks along these lines that we don't even see. Um, we see a lot of innovative financing. One of the things for consumers is this buy now, pay later. And this is becoming increasingly common. Even people at the bottom of the pyramid, the bottom of the economic ladder, are buying groceries this way. We see like auto defaults and 7-year auto loans. So there are concerns here about something going wrong in the system, and then it has a domino effect. And looking back, usually it's something we should have seen, but when it's not as clear, and again, I would also say the concerns about the US government and deregulation. This is part of what happened before when, deregulate the banks. And there was this race to the bottom and basically approving all of these loans, negative amortization loans, liar's loans, that is no doc or low doc loans. And clearly, we have had a lack of enforcement. And, this is another systemic risk. So it's not as clear as it used to be, but like you would look at the normal economic measures, a business cycle, and the tools like the Fed would have, or the government, the fiscal policy about tax cuts to stimulate you have all of these more, governmental systemic changes. So there's a lot of risk out there. I hate to be, negative, but again, our philosophy is most of our planning is oriented towards retirement. That money has to be there. So we even try to blend those money managers. Some will have more success one year than another, but controlling risk, if you're close to retirement or it's retirement money or you're already in retirement, is huge. And we will continue to preach that. However, if you're not invested, particularly as interest rates go down, you're not going to get enough return to have a long-term sustainable portfolio. So that's where you have to balance growth with risk, and that's certainly what we try to do. Okay, on that note, I will shut up and turn it over if there's any questions or comments.
Okay, great. Thanks, David. We have a question coming in from Mitch. Do you feel POTUS cares more about international relations than our needs in the United States, I imagine?
This, of course, it's a political question, and it's a personal kind of opinion question. And I think he definitely wants the United States to be successful. Part of this is the legacy, his own assets, his family. It's not like he's trying to destroy the United States, but it's a totally different approach in terms of our normal role in the world. So I think he wants to be successful both in the United States and internationally. This whole idea of, the Nobel Peace Prize. And one of the golden rules, I'm repeating myself for those who know me, I always want to give credit where credit is due, but also put the blame where it belongs. And it can be on the same person or the same institution at the same time on the same situation. So you want to give, credit, on things that may have gone well. Right now, getting hostages released and the U.S. participation in that in Israel and Gaza. You can't just look at one thing. You have to look at all of this.
And there has been a lot of change. And to speak to some questions coming in through the chat here, I'll just summarize and say that we're looking with our partners being independent. We use Cetera as well. And part of the information and research that we get, and you're looking through as financial advisor, do you notice any specific indicators or gauges that come through your desk where the stock market is headed toward a correction or something more severe, like a bear market? And if so, are we thinking that it's going to be more volatility, or are we thinking that in the next 1 to 5 years or during Trump's presidency, that we're going to see a major correction or maybe even a depression?
It's impossible to say. I'm not so worried in the real short term, like these next several months. Um, and again, the volatility sometimes it's just a tweet or just a post on social media, and it's not meaningful. So, for example, we have investment advisors, our money managers who get out of the market, and they're not. They're all fully invested right now. They do not have urgent warning signs to get out of the market. So, just to share that. Now, there are going to be problems, whether it's during Trump's term now or after. One of the problems is Social Security and Medicare. Towards the end, whoever comes in next, assuming Trump doesn't stay there behind what he's supposed to, will have to deal with this. It's the end of this next presidential term, 2033, 2034. That sounds way, far out there. But there's not enough funding for these programs, and by quite a bit. So what happens now? It could be solved at the last minute. It could be cuts in the benefits. It could be tax increases. But things are not the same as they were. You would think that we would solve our problems, grown-ups in the room, somebody, you go back, and I'm older, Ronald Reagan and Tip O'Neill, they would just hash out a deal. And of course, that is just not the case here. The debt and both parties deserve enormous blame for letting this grow and grow and grow, and it's still growing. So any notion that, oh, we're getting our financial house in order is absolutely false. We are not. And this is where this idea of small government, no, the budget is larger than ever. They raised the debt ceiling. And so we still have all of these problems, and we are definitely not fixing them. One of the things is on the tariffs, this is producing an enormous amount of income to the federal government, but it's in a way very regressive because it's being paid for by half, at least, is estimated by American consumers so far. And then some of it's being absorbed by companies. The auto companies are taking a hit terribly because a lot of the parts are produced in Canada or around the world. And you have these parts, or you don't produce a product. So there's, in my opinion, it is a whole new world. I don't minimize the risk at all. And you will see what happens. I don't want to be Chicken Little and say the sky is falling either. One thing to a really big picture, people get through things. I mean, people thought, the late 1960s, early 70s was the end, all the assassinations and, the hippies and Vietnam and people fleeing the country and avoiding the draft. And of course, going all the way back to the Civil War. And I look at other countries like Argentina, and, people find a way to get through, but that doesn't mean that there isn't enormous suffering. Um, People do fall off an economic cliff. So, and the United States is less prepared for this than other places who have been through cycles of economic turmoil. And we have not had some of this in a long time. The Great Recession, even that we came out of, and things got fixed. Of course, again, a lot of people had enormous financial losses from still haven't recovered. So the bottom line is it's impossible to know. Is there
Right.
corrections are normal, a bear market is normal, even though it's awful. A whole new Great Depression or something else, it's nobody can predict that really. And could it happen? Absolutely. This is one thing I've not people say it can't happen here. It can't happen here. Well, they said, oh, we're not going to ever have a global pandemic and 1 million people dead in the United States from a virus. Well, we did. So things can happen here.
On two hands, right? We have optimism about the US corporate earnings, but we also have this global uncertainty. So, as we're talking to investors and just general, as we're talking about citizens of the United States that invest in these companies, how should investors balance this optimism about US corporate earnings and AI-driven growth that's coming mainly from the United States against that backdrop of rising global uncertainty?
We want people to do well to make money when the market is up. So that's where I don't want people to be overly conservative. Now, if you've got a really long-term outlook, younger people, then we can do index funds if you can ride it out, the up and down. But for people who are close to retirement, it's for us is a question of risk control. We're responsible. We have to tell people, this, I say this, if people have money in the bank and that's where they feel comfortable, a good interest rate, and it may be more money than you might think that they should need as emergency money. We don't try to talk people into taking on more risk than they're comfortable with. And again, we do look at alternatives that, something may just have a fixed higher interest rate, or again, other guarantees, or it's a money manager that this is where I'm so proud of us. I think we are not people who are going to say, don't worry about it. It'll come back. This is all normal. And, yes, I know you're down 20 or 30%. Don't look at this statement. Just wait it out. For some people, that's fine. And it has worked, like 2008. But, we don't want people to be in that situation. Not that we can control everything, but we can try to plan to balance risks there of the market. And I think, blending them. So we've got, but there's just no way I'm going to tell somebody. The other thing that people try to do, advisors, is 60% stocks, 40% bonds. I had somebody, make a comment to me the other day, and I corrected them. They said, I've got all this money just in bonds, and it's just more conservative. And I'm like, wait a minute, what bonds? Bond funds, individual bonds, and then, there's a risk with high yield corporate bonds, which trade like stocks. And people don't understand this. So just don't assume something is low risk or risk free. And unfortunately, I hate to say this, that this is true of US government treasuries. The United States has never defaulted on its debt. And so this is considered risk free. There's a first time for everything. Nobody is predicting this, but what happens if this debt becomes unsustainable? That and interest rates rise. The United States has to pay more to finance this debt, and you just can't keep rolling it over. And the idea that people are getting away, other countries are getting away from the dollar, they're looking for another reserve currency or gold or crypto. That's a warning sign for me that this is not the same world. This is a different world. The United States is far riskier than it has ever been.
Thank you, David. Last question, 30 seconds or less. This is the last question. Is there any advice you would offer to clients who are feeling uncertain, given the various warning signs and volatility highlighted today?
I think the standard stuff, we always want you to know what you own, how it works. I repeat that a lot. So you don't have any mysteries there. And, we review it, even if it's something that is not, part of our portfolio that we have for you. So I always want that. I want you to control the risk. Well, I've gone on for a long time, but that's what happens when you're out of circulation for a while.